wherever you are and whatever time you're listening to this. Good morning, good afternoon, and good evening. This is the Market Color Podcast, where we keep you posted on the latest developments in the financial markets. And we do that by first giving you a broad overview of the global markets so as to give you a big picture perspective of the global economy. This is then followed by the Kenyan segment, where we review the performance of the domestic markets with a view to covering all the major asset classes. And finally, we wrap up the podcast by addressing the topical issue for that week so as to bring you up to speed with the latest financial headlines. Ladies and gentlemen, this here is episode number 178, and in this episode we are reviewing the performance of the financial markets during the 38th week of 2025, and that is from Monday the 15th to Friday the 19th of September. And without further ado, this is your host Jamuhuri, and together let's dive right in. We kick it off in the United States, where on Wednesday the Federal Reserve approved a widely anticipated rate cut and signaled 2 more rate cuts were in the pipeline before the end of this year, as concerns intensified about the U.S. labor market and as inflation appears to be making a comeback. In an 11-1 vote, the Federal Open Market Committee lowered its benchmark overnight lending rate by a 0.25 percentage point, which puts the overnight funds rate in a range of between 4% to 4.25%. In its post-meeting statement, the committee characterized economic activity as having moderated and noted that growth in jobs had slowed down, whilst inflation had moved up and remained somewhat elevated. The Fed statement also noted that the committee remains attentive to the lower jobs growth and higher inflation, which present a double risk to the Fed's dual mandate of price stability and full employment. In the United Kingdom, according to data released by the Office for National Statistics on Wednesday, the annual rate of inflation in the UK was steady at 3.8% in August, which was in line with market expectations. Meanwhile, core inflation, which excludes volatile food and energy prices, these rose at an annual rate of 3.6%, down from 3.8% in the previous month of July. The Bank of England has forecast that inflation could peak at 4% in September, which is double its 2% target rate. In related news, the latest monthly economic growth data showed that there was a 0% growth in July, spurring concerns that the UK economy was slowing down. The Bank of England is also focused on the cooling jobs market and slowing wage growth, which could help to ease inflationary pressures and possibly lead to further rate cuts in the coming months. On Wall Street this past week, stocks rose on Friday as all the 3 major indices recorded weekly gains following the Federal Reserve's decision to cut interest rates midway through the week. Stocks received a boost after the Fed lowered its benchmark policy rate by a 0.25 percentage point on Wednesday, which was its first rate cut this year. This move was widely anticipated by the markets, but stocks still experienced a volatile trading session after the Fed chairman characterized the decision as a risk management cut that was intended to balance between the Fed's dual mandate of price stability and full employment. Wall Street was on track for a strong weekly performance, with Apple shares leading the way with an increase of 3.2% as the company's latest iPhone went on sale around the world. For the week, the broad market index, that is S&P 500, rose by 1.2% to close at 6,664, whilst the Dow Jones Industrial Average increased by 1% to reach a new record high of 46,315, and the tech-heavy Nasdaq Composite advanced by 2.2% before coming to a close at 22,631. In the U.S. government bond market, despite the Fed's rate cut on Wednesday, U.S. Treasury yields rose on Friday as investors weighed the state of the U.S. economy as well as the future direction of monetary policy. Against the backdrop of a policy rate cut and a dip in short-term rates, the yield pickup in longer-dated U.S. Treasury yields initially appears counterintuitive. However, the point to note is that investors in longer-dated bonds take into consideration not only the future direction of short-term rates, but also the likely direction of other factors such as economic growth and government finances. In this particular case, investors are considering the amount of debt that the U.S. Treasury will need to issue in order to finance its current spending, in addition to rolling over its existing debt. The intraday yield for both benchmarks was the highest in the past 2 weeks, with the yield on the 10-year Treasury bond gaining more than 2 basis points to close at 4.12%, whilst the yield on the 2-year Treasury note added less than 1 basis point to settle at 3.57%. For your information, 1 basis point is equal to 0.01%, and bond yields and prices move in opposite directions, which means that as interest rates rise, bond prices fall, and vice versa. In the foreign exchange market, the US dollar rose on Friday, extending its rebound against most major currencies as traders reassessed its short-term outlook after the Federal Reserve cut interest rates, but signaled that further easing would only proceed at a gradual pace. Prior to the Fed's decision, the dollar had come under intense selling pressure, and this was on the back of the widely anticipated rate cut. After the confirmation of gradual easing, the dollar began to correct and may still have more room to rebound further. The dollar index, which tracks the value of the greenback against a basket of 6 other major currencies, this initially fell by 1% before the Fed's decision on Wednesday, but thereafter recovered and was up by 0.3% on Friday as it came to a close at 97.65. In the commodity markets, the price of crude oil fell on Friday as concerns about increased supplies and declining demand outweighed expectations that the rate cut by the Federal Reserve could trigger more consumption. The Fed cut its policy rate by 0.25 percentage point on Wednesday and signaled 2 more rate cuts before the end of the year. Lower borrowing costs tend to boost the demand for oil, and this in turn pushes up crude oil prices. However, data from the U.S. Energy Information Administration continues to indicate weakening demand, tempering any expectations for a significant pickup in crude oil prices. At the end of the week, both benchmarks recorded a second consecutive week of gains, with the global benchmark Brent crude closing the week at $66.68 a barrel, whilst the U.S. benchmark, that is West Texas Intermediate crude, settled at $62.68 per barrel. In the precious metals market, the price of gold ticked up on Friday and was on track for its fifth consecutive week of gains as the Federal Reserve delivered its first rate cut of the year and signaled another 2 rate cuts before the end of this year. Following the Fed's decision on Wednesday, the price of spot gold hit a new record high of $3,707 before retreating in a volatile trading session. The bullish trend for gold remains intact, with new record highs inevitable as traders predict that gold could break above $4,000 before the end of the year. For the week, the price of spot gold was up by 1.1% to close at $3,683 per ounce. And just for your information, gold is considered as the ultimate safe haven asset and is traditionally viewed as a hedge against inflation and economic uncertainty, and tends to perform better in a low interest rate environment since it doesn't pay out a regular coupon like a bond. We now change scene to the Kenyan financial markets. And we start by looking at the domestic foreign exchange market, where during the past week, the Kenya shilling remained fixed versus the US dollar. And according to data from the Central Bank of Kenya, the official exchange rate for the dollar was quoted at the same rate of 129.24, which is the seventh week in a row that the dollar shilling rate has been at this exact same level. Meanwhile, the sterling pound was priced at 176.61 and the euro was valued at 153.19. And on the regional front, one Kenyan shilling was changing hands for 27.08 Ugandan shillings and 19.11 Tanzanian shillings. And to the Rwandese franc, it was posted at 11.22. Despite the Central Bank of Kenya operating a floating exchange rate policy, the dollar-shilling exchange rate has been stuck at between 129 to 130 shillings over the past 2 years and now appears to be operating like a fixed exchange rate. Given this previous price action and barring any external shocks to the domestic economy, we expect the shilling to remain range-bound in the short term. However, in the longer term, the outlook for the shilling still remains negative, and this is evidenced by the country's excessive national debt, which now stands at about 70% of the country's gross domestic product and consumes about 60% of total revenue collections. On foreign exchange reserves, during the past week, Kenya's usable foreign exchange reserves declined by a massive $309 million for a grand total of $10.86 billion, which is equivalent to 4.8 months of import cover. This level of reserves is in line with the central bank's statutory requirement to endeavor to maintain at least 4 months of import cover. Despite this fact, Kenya's foreign exchange reserves remain under intense pressure, and this is partly due to the persistent current account deficit, where imports perpetually exceed exports and is further exacerbated by our ever-increasing external debt repayments that have pushed the country to the precipice of a sovereign debt default. In the money markets, during the past week, the interbank market was liquid and remained well funded with the support of the Central Bank of Kenya through open market operations. For your information, open market operations refers to the purchase and sale of government securities by the central bank in order to regulate money supply and interest rates in the interbank market. The overnight interbank rate, which is now referred to as the Kenya shilling overnight interbank average, this is the rate that banks use to lend to each other and is now the new reference rate for lending transactions by commercial banks. The overnight interbank rate ticked up by 5 basis points to 9.50% and was spot on with the central bank rate, which is also at 9.50%. Meanwhile, the excess reserves held by commercial banks in relation to the cash reserve ratio of 3.25%, this stood at 11.1 billion shillings. For your information, the cash reserve ratio is a statutory requirement that specifies the percentage of total customer deposits that commercial banks are required to hold with the central bank for liquidity management. In the government securities market, the weekly Treasury bill auction was held on Thursday, the 18th of September, and the central bank received bids totaling to 22.9 billion shillings against an advertised amount of 24 billion shillings, representing a performance rate of about 95%. The central bank ended up accepting 22.7 billion shillings, and the results of the auction were as follows. The 91-day rate dipped by 2.5 basis points to settle at 7.94%, whilst the 182-day rate declined by about 1 basis point to close at 8% flat, and the 364-day rate ticked lower by 1 basis point to average out at 9.53%. In the primary bond market, the second auction for the September bond issue was held on Wednesday, the 17th of September, and the central bank received bids totaling to 97.2 billion shillings against an advertised amount of 40 billion shillings, representing a performance rate of 243%. The central bank ended up accepting 61.4 billion shillings, and the results of the auction were as follows. For the first bond, which was a 20-year bond that was initially issued in 2018 and now has 12.5 years left to maturity, the central bank accepted 23.5 billion shillings at a weighted average rate of 13.58% compared to the bond's coupon rate at 13.20%. And for the second bond, which was a 25-year bond that was initially issued in 2022, the central bank accepted 37.9 billion shillings at a weighted average rate of 14.14%, and this is compared to the bond's coupon rate at 14.18%. Up next is our topical issue. And this week, we are looking at the reduction in loan write-offs as banks adopt a more aggressive recovery strategy. The Central Bank of Kenya has requested commercial banks to reduce the cost of borrowing in line with the revised risk-based credit pricing model. The call to bankers comes amid a persistent push by the regulator for the banking industry to pass on the benefits of lower interest rates by reducing their cost of borrowing for customers. The new credit pricing model is based on the overnight interbank rate, which is now referred to as the Kenyan shilling overnight interbank average, and is also closely aligned with the central bank policy rate. And according to the Central Bank of Kenya's latest financial stability report, Kenyan banks reduced the total amount of loan write-offs by 26 billion shillings in 2024 as they adopted a more aggressive recovery strategy that triggered a wave of auctions, receiverships, and liquidations. The report shows that banks wrote off 7 billion shillings in loans in 2024, compared to 33 billion shillings in 2023. The central bank's prudential guidelines define a non-performing loan as a loan where principal and interest repayments are overdue by more than 90 days. In addition to that, the central bank also requires banks to write off loans when there is no realistic expectation of recovering the loan. As non-performing loans continue to increase and in an attempt to reduce loan write-offs, commercial banks have tightened credit standards and doubled down on loan recovery efforts. According to the report, in response to the aggressive loan recovery strategies adopted by commercial banks, the amount of loans recovered increased from 4.7 billion shillings in 2023 to 5.2 billion shillings in 2024. And on that note, we come to the end of this week's podcast. Thank you for listening to the Market Color podcast, and I hope that you found it to be useful and informative. And if so, please share it with your family and friends and also help to keep them informed of the latest developments in the financial markets. Please also consider becoming an active subscriber with a minimum monthly contribution of just $10. And for more information on how to become an active subscriber, please check out our support link at buzzsprout.com/1999543/support. And as always, your support is very much appreciated. For your information, the Market Color podcast is hosted by Buzzsprout and is also available on all the major hosting directories, that is Apple Podcast, Spotify, and Amazon Music. And if you have any ideas or feedback on how we can improve this podcast, please feel free to reach me on the following email address, that is jamuhuri@gmail.com. Jamuhuri spelled Jamuhuri. Once again, thank you for your continued support, and I look forward to interacting with you again next week. And in the meantime, please do have yourself a blessed and fantastic week ahead. And remember, it doesn't interest me what you do for a living. I want to know what you ache for, and if you dare to dream of meeting your heart's longing. The first line in The Invitation by Oriah Mountain Dreamer. Think about it. Thank you, and God bless.